Good morning, this is Mayor Valensky with Driving Markets. Okay, so let's look at what was driving markets today. Well, yesterday was a really funny day. It was President's Day in the States, so the markets were closed, but the futures were open globally. And the market started off pretty well in the morning. It rose quite well. The mornings looked quite solid. I was quite surprised, considering that the Russia-Ukraine crisis is still bubbling along and there was some exchange of fire, etc., etc. And then late morning in Europe, and early afternoon in Europe, the markets began to sell off significantly. In fact, the Dow futures closed down around about 600 points on the day. The Nasdaq was hammered. S&P and European markets, the DAX was completely hammered. It was down 300 points at one stage. The FTSE was down. Across the board, all markets were down. Purely in this particular case, based on the Russia-Ukraine crisis. Let's just discuss that in a bit more detail. Russia is a big provider of grain, wheat, barley, etc., etc. All the soft commodities. Russia wants to invade Ukraine mainly because they want to secure the energy pipeline there. Remember, the pipeline passes through Ukraine to Europe. If they can grab Ukraine, this is Putin's real motive. If they can grab Ukraine and they can secure their energy supply, then they can in effect control and dominate the European market and the Europeans. So that is the motivation behind Russia invading Ukraine. That is the only motivation, is purely to get hold of the energy that passes through Ukraine, the oil, the gas that supplies Europe. Okay, that would put Putin in a major power position and will strengthen his position globally, make him much more threatening to the world by turning on and turning off the gas accordingly. As you can see in Europe and the UK, gas prices, energy prices have shot through the roof, excluding petrol, excluding oil. You just got regular gas prices have gone up by about 70%. So just be aware of that. And as we go on, those energy prices will rise, the more the threat is from Putin and his Kremlin government. The other thing to look at, which is very interesting, is the soft grains. I don't know if you're aware, but you need to probably, or you should probably, my opinion, look at the soft grains and see where they're going, because if the war develops or there is a major conflagration, a major war, then you're going to have soft grains go through the roof, and that will cause a major supply blockage across the whole of Europe and the world, and the price of your local packet of rice and pasta and all the other grain material within your shop, whether it's Tesco, Safeways, Walmart, or wherever you shop, that will be significantly affected and will push the price up dramatically. So you may want to look at some soft commodities as going long on them and seeing where they're going over the next 6 months to a year, because if there is war, then those soft commodities will double or triple in price, in my opinion, which will feed through to the local store, and the local store prices will shoot up, and therefore that will feed further to inflation. So remember, please note, I've said all along that inflation is already high enough. If there is a escalation of the war between Russia and Ukraine, you will see inflation running in the 20 to 30% levels. And at those levels, interest rates will have to be super high in order to cope. So what you've seen of COVID would be a game, a child's play, compared to what you'll see if the Russia-Ukraine crisis develops further. Be aware of that. If that develops further, that will feed through to a price rise across the board and a supply chain problem. Okay, the main issue will be a supply chain and price rises if Russia and the Ukraine crisis develops further. There is already a frustration in the world regarding supply chain. That was caused by the pandemic, but that would be nothing compared to the supply chain issues that will develop as a result of the Russia-Ukraine crisis. So look at the soft commodities, start hedging, because you never know where this could go. If the crisis develops further, then what you see today will be dreamt about in months to come, saying how good it was. Okay. Also be aware of something else which came along, that airlines are increasing their prices across the board. So the cost of airline tickets globally is going up. some by 20%, some by 50%, some by 100%. Okay, simply because the airlines have not captured enough profit over the last 2 years due to the pandemic, and now they want to exploit the opening of all of the borders and the releasing of the restrictions by whopping on the prices. Be aware of that. That's also going to add to inflation. So you've got, wherever you look at, whether it's the leisure industry, whether it's the food industry, whether it's the travel industry, whether it's the transport industry, you've got major price increases across the board. How do you hedge against it? So what you need to look at is looking at some put options which will make your profit if the markets go down. You can look at some CFDs. That's on the retail side. You can look at hedging some of your stock by reducing the size in your portfolio, or you could take the view that I'm completely wrong and everything is only going to go up, which you could do. Who's to say it's not only going to go up? It could be that we're completely wrong on all economic and geopolitical factors, and you could have a situation where the markets are only going to continue rising. I'll state it again, in my opinion, the markets are going to go down significantly. That's my opinion, and you should be looking to short the market. However, we could be looking back in a month, 2 months, 3 months, 6 months, could be completely wrong. You could have the most rosiest picture, and you could have Putin with Biden dancing on the beach, singing Kumbaya, my lord. This is Mayor Valensky with Driving Markets. Have a beautiful day.